All right, today we're going to talk about the collision of two massive forces. On one side, you've got this slow-burning crisis in our retirement system, a crisis that affects millions of people. And on the other, there's this brand new financial tool, something called digital credit, that might just be the answer everyone's been looking for.
So let's just get right to it with a question that really hits home. Is the money that's supposed to be there for your retirement? Is it being used to make incredibly risky bets, maybe without you even realizing it? Well, for a shocking number of people, the answer to that is a hard yes.
And just to give you a sense of the scale we're talking about, look at this number, almost $46 trillion. That's how much the U.S. pension system was holding in retirement assets as of mid-2025. I mean, it's one of the biggest pools of money on the entire planet. But there's a huge problem hiding just under the surface.
And here's the problem. This chart shows a pretty startling gap. On average, public pensions only have about 83 cents for every single dollar they've promised to pay out. But honestly, it gets way worse. If you look at the bottom quarter of these funds, they're only 60% funded. That's a staggering 40% shortfall they somehow have to make up.
So what happens when you have a hole that big in your balance sheet? Well, you get desperate. To try and earn their way out of this mess, pension fund managers are forced into what you could call a desperate hunt for high returns, and that means taking on enormous and often totally hidden risks.
And check this out. This is a perfect real-world example of just how extreme this can get. This is the actual asset allocation for one healthcare company's pension fund. A whopping 60% of it is in private equity. You know, investments in private companies that are super hard to value and you can't just sell them tomorrow if you need the cash. This means over 3/4 of their entire fund is locked up in these kinds of high-risk, illiquid assets.
So you have to ask, why would they do this? Well, here's the kicker. A former chief investment officer called this strategy accounting alpha. You see, because these private assets are only priced every 3 months, they don't show the wild daily swings of the stock market. This basically masks the real volatility, making their risk reports look deceptively stable. For the people running the fund, this was a feature, not a bug.
And look, this isn't just some theoretical risk we're talking about. It has very real consequences. For example, in late 2024, the big retailer Saks Fifth Avenue issued over $2 billion in debt. Fast forward about a year, and that same debt is trading for a penny on the dollar. It's practically worthless. Now, imagine that being a core part of your retirement plan.
It's exactly this environment, right? This mess of hidden risks and desperate chasing after returns that created the need for something totally new. And that's where a financial tool called digital credit comes into the picture.
So what exactly is this stuff? Okay, think of digital credit not as a loan, but as a form of permanent ownership in a company. When a company issues it, that money is theirs to keep. No due date, no repayment down the line. In exchange, investors get a steady cash flow, kind of like a bond. And here's the crucial part. It's all backed by transparent, easy-to-trade assets that are already on the company's books, like Bitcoin.
The difference here is like night and day. Traditional debt, it's a temporary loan. It has to be paid back, and it's backed by, well, by optimistic guesses about future profits. Digital credit, on the other hand, is permanent equity. There's no looming repayment, and it's backed by real assets that you can see on the balance sheet today. So you're basically trading a reliance on a future promise for ownership backed by existing assets.
So if this tool is so perfectly designed to solve the problems pension funds are facing, why haven't they all just jumped on board? Well, the world of big institutional investing moves incredibly slowly. It's governed by some very, very rigid rules.
And here's the crucial point. These big institutions are run by these strict rule books called investment policy statements. And a really common rule in those books is that they cannot invest in any new product until it has a proven 3-year track record. This literally creates a mandatory waiting period for any innovation, no matter how great it seems.
And this rule creates a pattern you see all the time, known as the hockey stick adoption curve. For the first 3 years, growth is slow, it's pretty linear, because the product is just building its track record. But once it hits that 3-year mark, all of those institutional doors can suddenly swing wide open, and that's when you see the potential for explosive, exponential growth. And we are right there at the very beginning of that timeline.
So that brings us to right now. With the clock on that 3-year track record officially ticking, 2026 is the year this whole story starts getting told to the wider market. It's the beginning of the marketing push.
And the backdrop for this story is actually really strong. We've got a solid economy, huge growth in AI providing some stability, and at the same time, less regulatory fear combined with ongoing global uncertainty makes alternative, transparent assets look a lot more attractive. It's pretty fertile ground for an idea like digital credit to really take root.
This quote just says it all, doesn't it? You know that old saying that people find Bitcoin when they need to find it? Well, the same exact logic applies here. As the pressure keeps mounting on these pension funds, their need for a real solution just gets more and more urgent. And that window of time they have to fix their problems, well, it is closing fast.
Which leaves us with the ultimate question, really. On one side, we have a multi-trillion-dollar problem that threatens the retirement of millions of people. And on the other, we have an innovative new tool designed specifically to fix it. The only question left is, can a bureaucratic, slow-moving system adapt quickly enough to save itself?